Some pre-engagement activities that the audit firm will engage in is this idea of this client acceptance or continuance, right? So obviously if it's a new client, the partner or an engagement team has gone out to solicit this client, right? They bid on the client and now they have the client or the clients approach them and say, you know, we're looking for new auditors, we invite you to bid, right? So they have to determine, is this a client that we want to accept? So firms are not going to, especially the larger firms, they don't have to, for one thing, right, because they're so large, but they're not just going to accept clients, right? They're going to do a background check, they're going to talk to business people that the client or companies that that client has done business with, lawyers, bankers, right? If it's a publicly held company, they're going to look at the client's history with the SEC. They're going to do background checks on management, because what are they concerned about? What do you think the audit firm is concerned about before accepting a client? What's their concern? John?
That maybe they'll try to influence the things like they won't hide some information.
So that's a good way, and basically saying integrity, right? They're concerned about the integrity of the person or the clients that they get into business with, right? So if the client lacks integrity, what's the consequence to the auditor, do you think? If you're dealing with a client that lacks integrity? Yes, Ella. Right, they might not get all the information that they need to complete the audit. The information might be biased in some way, or the client might be, not very truthful. Victor.
The auditors sign off on the statements, and it's later found out that there's fraud, and it's the auditors look at it.
Right, they're concerned about their reputation. There's reputational effects of dealing or associating with certain clients, and also it's going to have an impact on your existing clients. Right, your existing clients, and you saw this in the early days of Enron, when Enron broke, right? That given the problems that existed at Enron, and also Andersen had a string of some significant audit failures with WorldCom, Enron, right? Clients started leaving Andersen, right? Not because Andersen had done anything wrong with their books, but it was the perception in the market. They didn't want to be associated with Andersen necessarily, because they didn't want to invite that scrutiny on their books and records, because they felt as though the market might look at them, or the SEC might look at them and say, okay, this is an Andersen client, now we're going to scrutinize this client a lot more. So they had a lot of clients leave them because of that reputational effect. So firms are very concerned about their reputation. We talked about legal liability, litigation, that whole deep pocket syndrome. So if you're associating with a client that lacks integrity, or you don't feel that that client has the highest amount of integrity, you're going to take pause and say, is this a client I really want to be associated with? Because what's the outcome? What if the client did, because obviously firms take on, there are clients out there where, certain members of management lack integrity, they're still getting an audit done, right? They're publicly held company, they have to have a firm, an audit, and a larger firm, right? So what do you think the audit firm does to protect themselves in that situation? How might they protect themselves? So if, let's say that, the audit firm says, okay, this management, they don't have the highest amount of integrity, but we can do this audit. How do you think they protect themselves? Contracts and what other, right? So they lay things out. This is what we're going to do. This is what you're going to do. Okay? What other way, man? I'm thinking monetary. So that they have risk now. How can you compensate yourself for the risk? Right. It's audit fees. Right. You could, so firms can price protect themselves, right? Because like, okay, we're increasing our risk. Think about it. If you are, you're going to pass that risk on to the client, and you pass that risk on to the client in terms of the fees that you charge that client. So when you have riskier clients, you can, an audit firm could probably charge that client more. And the reason that they can charge that client more is because if you have a riskier client, and when we talk about the audit risk model, we'll see the correlation. You have a riskier client, you have to step up your audit effort, right? So that means you're going to look at more documentation, you're going to go through a lot of things. You're not going to rely necessarily on all of the internal controls, which means you're going to do a lot more testing. That's greater audit effort. And that greater audit effort should translate to greater audit quality to help protect you against the risk of dealing with a client that might not be, as reputable.
Does that message define itself that the audits are raised expected of
Well, not necessarily. I mean, you have to phrase it, be very diplomatic about it. You don't say, we think you're a liar, and we're going to charge you a lot of money, right? But I would imagine if you're addressing a situation like that, what you'd say to the client is that here's where the risks are. That's when we do the risk assessment. We feel that there's greater risk here, right? And as a result of that, we're going to have to, increase our audit effort, right? So you would phrase it in the way of and remember, the audit committee hires them, right? If you're a publicly held company, the audit committee has to hire you, and you could go to the audit committee and say, here's the concerns that we have. We have these concerns, and as a result of that, we have to increase our audit effort in the amount of time. We have to put in, we have to staff the job with more experienced personnel. And because we're staffing the job with more experienced personnel, that's going to cost more money. So I'm sure, partners are salespeople, right? So they know how to. You're definitely, because if a client thinks that you're already suspecting them, then what? Then they're not going to hire you, right? But if you're going through the audit committee wants to hire because they have responsibilities, right? So they want to hire an auditor who's going to be more diligent and not necessarily roll over. Okay, so that's the client acceptance and continuance. So we go through this whole engagement planning, business risk assessment, audit risk assessment for both new clients that we're accepting as well as continuing clients. Also, if it's a new client, it's probably been audited by another company, especially if it's certainly if it's a publicly held company, right? They've had prior auditors. So you're expected, the standards say that you have to communicate, or at least attempt to communicate with the predecessor auditor. The predecessor auditor has no responsibility to communicate with you, right? But you have to show, as the auditor, that you attempted to communicate with the predecessor auditor. Now, what you get out of the predecessor auditor might help you and it might not help you, right? Because there's still these concerns about client confidentiality. I don't know that a predecessor auditor is going to tell the current auditor, look, we got the heck out of here because, we don't trust these guys, or we were fired. They're not going to necessarily say that. So the amount of information that's really useful to you that the predecessor auditor provides might not be that great, but at least you want to, the standards require you to attempt to communicate with the predecessor auditor to find out information that might be useful. Obviously, we talked about independence and we talked about ethics over the last couple of weeks, and firms have to know before they're staffing that engagement, are there any issues, right? Does the partner have a spouse that works for that client? Or do you have any holdings? So you want to make sure that the audit team is independent, the engagement team is independent, and making sure that the team meets all of the independence and ethical standards. I talked about the engagement letter, which is a contract between the client and the auditor, which lays out what the auditor's responsibilities are versus what the client's responsibilities are. And then also if this is a client that you are rotating off, or the client has said to you this will be the last audit that you have to do, we're not going to really get